Dear viewers, we have just completed Q2 of financial year 24-25. It's time to take stock of what's happening in the Indian stock markets, what are its threats and what are its opportunities as observed by the fund manager. In this episode, Expert of the Week, fund manager Harini Dedhia is going to take you through the observations she has made both in the Indian markets as well as in the international market. Her observations are very important and has a bearing on the outcome of investment that you could be doing in the quarter ahead. Stay till the end of this video to get all the finer points of the observations made by her. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
To take you through the threats and opportunities in the Indian stock market, we have invited today fund manager Harini Dedhia for her observations on what she saw in the markets during the last quarter. Harini Dedhia is not somebody who is new on the channel. She has done countless videos in the past. She is fund manager by profession, works for Tamohara Investment Manager. She started her career from New York working for a hedge fund and later on migrated to India to pursue her career in India. Welcome to this episode, Harini Dedhia, and it's over to you to take you through what you observed in the Indian stock market.
Thank you, Dr. Bhatt, for that kind introduction as always. Thank you for always calling us every quarter to come discuss our views on the markets, on the macros and how they stack up and how we would position our portfolios at such a time. Coming back every quarter and doing this exercise, it keeps us honest as well. It keeps us thinking, oh, this is how we were thinking last time. What has changed from that point of view? What has not changed? Where have our guesses been right? Where have we been wrong? Thank you so much for giving us that opportunity again. As always, we will start off, with the market outlook. In that, we will first assess what has happened in the last quarter. We will look at how macros have stacked up. This time around, we want to spend a little more time on discussing really what has happened in the last 5 years rather than just discussing, last quarter in isolation and trying to take a sort of a more of a bird's eye view on how things have shaped up and basis that understand what our expectations are going forward. As always, we will end this discussion with our views on the markets currently, as well as on where we see opportunities coming up in the Indian equity markets specifically going forward. So with that in mind, let's start off. So not much has changed in the equity market since we last spoke. There has been pretty much flat movement on the equity indices from July to October now. We've seen, of course, in the last couple of weeks, thanks to the Lebanon war, or just the general occurrences in the Middle East, we've seen equity markets starting to take a bit of a correction here and there, but nothing major so far has happened on the equity markets point of view. So markets have more or less been flat, and going forward also that remains our expectation. That is something that we discussed last time as well. The two areas that I really wanted to highlight, one was, of course, gold. This is something that we've been highlighting for the last two calls, that, the gold rally is telling us something about what risk perception is turning out to be in the world. And this rally in gold prices is sustaining. We're well above $2,600 now. So that's something that tells us that, people are wanting to shift at least some allocation to safety. And for India, the other macro that has shaped up well has been crude. We've seen crude prices correct to below $70 a barrel. Now, of course, last week, as the escalations between Iran and Israel flared up, we've seen crude inch back up to $73, $74, but nowhere near the $90 mark where we were last year at this point of time. So despite the instability that we're seeing in the Middle East, and, all of the supplies and the trade routes that get blocked as a result, or could potentially get blocked as a result. We're not still seeing crude go back to the levels where we were last year. So that's sort of a blessing in disguise for India. That would be probably our large concern, from this global geopolitical event from a macroeconomic perspective, of course, not from a human perspective. So those two are the big macro trends to highlight. Fed has gone ahead and cut interest rates by 25 basis points, which is then getting reflected in our 10-year. So, finally, we're seeing a little bit of a, rationalization, that we were discussing, that it's an anomaly when, equity markets, bond markets, gold, all three go up. It is surprising to see all three go up. Gold going up is always an indication that people want to shift to safety. And in light of that, the corollary safety asset that we always talk about in the world is, of course, US Treasuries. So we generally see money going out of one safety class to another, or money altogether leaving a risk class like equities and going to another. However, none of the two events happened. And now we are seeing some softening in rates prompted primarily by the Fed's cut, and then, of course, sustained by flows going more and more into gold versus US Treasuries. So equity markets flat. We are seeing Fed cut rates, and that sustain in the rates today, the 10-year being much lower than where we were last quarter. And we're seeing gold remain extremely strong. So I think overall there is a call there. Somewhere people have started to take that, we need to be a little more safe with our assets, and by safe, we mean gold and not, just simply moving money to cash or US Treasuries. So that's the view that, incrementally more and more people are taking. Now, with all of this being said, I think one thing I just wanted to highlight over here is that Indian macros, and we said this in the last call as well, and we discussed it at length, in fact, Indian macros are actually fairly strong. You see it in our forex reserves, you see it in our currency, you see it in our current account deficits, you see it in our government fiscal deficits. We have a very good balance sheet at the government end. We have a very, very strong balance sheet at the corporate end. So there is not a lot of concern that's there on the Indian macro front. So with that context being laid out of how macros have stacked up for the last quarter, let's actually zoom out and understand what has happened in the last 5 years, so to speak. And these 5 years have been stupendous for returns, especially in the Indian equity markets, but globally we've seen the US equity markets also do extremely well. So let's take a look at what really drove these returns. And returns everywhere are a factor of two things. One is, of course, the fundamentals, which we will call earnings in this case, but essentially pointing out to the overall health of the economy or the businesses that are a part of the index. And the second being technical, which is, I would put it under a broader term called liquidity, right? The amount of money that is chasing a particular asset determines the price of that asset. So we will evaluate the last 5 years on both these parameters and, try and end that discussion with where we go from here on, right? So where do we really position ourselves from here on? What should our expectations be going forward? So in the last 5 years, when we look at BSE 500, so these are the top 500 companies in India, and we look at their earnings growth, and we're looking at ex-financials because in financials, there are a lot of adjustments that keep on happening, and P&L is not really the right way to look at these businesses. So when we look at BSE 500 ex financials, what we've seen is that we've had 11% growth on top line. So that's revenue. So 11% revenue growth for the last 5 years, which has yielded a 13% growth in EBIT or operating profits for the last 5 years. On this 13% growth, we have seen a 22% compounding in stock prices. Right? And I'm just talking index level. Of course, there are a lot of people and a lot of companies that have done far, far better than that. This is something that is staggering in terms of the amount of re-rating that has actually happened, right? Because the fundamentals have not shifted from their trend of, 11, 12% nominal GDP growth and then some incremental profit growth coming by. But we've seen, somehow price growth take that same, 11, 12% growth and price it far, far better than what it was getting priced at maybe a decade back, right? So what this indicates is that a lot of the returns have come not from fundamental earnings reasons. Of course, 50% have come from that, but the remainder has come from re-rating or, multiple expansions that we've seen in the Indian markets. When we look at multiple expansion across the board, right? So first, let's look at the broader indices like large cap, mid cap, small cap. 50% or higher of the return from the previous peak. So previous peak of the market was made in October 2021. So from the previous peak to today, more than half the return has come from multiple expansion. And in fact, for mid and small cap, it's 2/3. So more than 2/3 the return has come from multiple expansion. And this is very, very significant amount of, valuation growth that we've seen. This is not something that you can keep on sustaining. So first expectation to sort of recalibrate for Indian equity investors would be to understand that these broad market moves where you've seen 22% kind of compounding on the index level, that's not something you can continue to expect because frankly speaking, underlying earnings are not growing at that pace, right? And you can't have multiples keep on expanding. I mean, we've already come to Mount Everest here, but you can't really have them expanding quite beyond that. And we'll discuss why they've expanded and why we think that, now there are going to be chinks in the armor, there are going to be dents over here where we're not going to see this expansion continue. But investable idea, so to speak, to take from this particular data point is that financials have seen far lower expansion than any other sector, be it large cap, definitely large cap, but even in mid and small cap. Right. So in financials, most of the growth in stock prices has come as a result of earnings growing and not because of multiple expansion. So that remains to be a pocket of sanity. And that's probably another reason why we believe the broader index, and by the broader index, I mean the Nifty 50, so the larger index rather, to stay pretty resilient because more than 30% of the weightage in this particular index comes from financial sector. But we'll cover more on that a little bit later. What has really driven this multiple expansion, especially in mid and small cap? Of course, the answer is in flows. We've seen tremendous amount of flows coming into the mutual fund industry. So this is just the data from the Association of Mutual Funds India on what is the AUM like between large, mid, small cap, and then of course the new thing right now, which is the sectoral and thematic funds. If you see the proportion of increase in mid and small cap has been far greater than large cap. Of course, these indices have outperformed large cap, but they've outperformed also on flows. It's not just an outperformance on price, but the outperformance has also come on flows, and it's become a sort of a self-reinforcing cycle, right? The more money that comes in, the more money chasing that same amount of stocks, and then they keeps on driving prices higher and higher. And looking at those near-term returns, there'll be more investors who invest. So it's become a circular sort of game over there. However, we will examine what can possibly dent this narrative going forward, but more on that later. The other thing I wanted to highlight was, of course, the sectoral and thematic funds. Now, we've seen inflows in these NFOs, in sectoral and thematic funds, in the first 7 months of 2024. Be 3x of what we saw in 2023. That is the amount of craze that is there for equity and for stories within equity, right? So this could be a defense fund, a manufacturing fund, a cyclical fund, all of that. So all of that gets clubbed into sectoral and thematic fund. And we are seeing significant amount of inflows coming into these sectoral funds. And something very interesting about investor behavior over here is that when you invest in a sectoral fund, you are also, in a way, as an investor, actively taking a call that I believe that this sector will do really, really well in India. And in our experience, when so many people start to have, opinions and beliefs on which sectors will do well and which won't. And so many people are starting to track it, that they are, taking these calls very, very actively. It is pretty much the time that one should start getting cautious on what to expect going forward. Another way to really look at how much valuations have increased is to try and understand the percentage of stocks that are now getting valued at over 50 times price to earnings. 50 times is a very, very steep number. We typically, in the last decade, we've typically seen only consumer staple companies, right, where it's just predictable that you're buying a Colgate toothpaste today, you're going to buy it tomorrow. Those kind of businesses trade at such multiples in India. We've not really seen, a much broader section of the market trade at such multiples. But what has happened in the last decade is in the large cap space or the mid or small space, we've seen almost a doubling in numbers of companies that trade at more than 50p. So in 2015, we had 15% of large cap at 50p plus. This would predominantly be your consumer stocks. In 2024, that number sits at 34%. And in mid cap, which is where the number of stocks is much lower and the flows have been as high as small cap funds, we've seen 17% companies which were trading at over 50p multiple in 2015 now go up to 39% rather. So there's been a staggering increase, and this has been a continuous increase, right? Barring large cap, where we've seen 2022 to 2024, there's been a minor correction in the number of companies that trade above 50p. Across the board, there has been a steady increase. The steepest increase in the last 2 years has, of course, been in small cap, where 18% was trading above 50p in 2022, and now it's at 28%. There has been a significant re-rating that has happened, and it has been happening over a period of time, right? So the thing to remember is that this narrative is not a flash in the pan narrative. This narrative has been building up. A case for India has been building up over a period of time, which is why we don't believe that it's going to deflate that easily, because as we discussed earlier and on our last call, the macros of India remain very, very strong, right? But what can really cause a chink in the armor over here, right? So what has happened is narratives, as we've seen, has driven liquidity, which has sort of taken over earnings as the primary driver of stock prices, especially in the last 18 months, where we've seen significant amount of re-rating happened. More than half of the returns are coming from re-rating. So let's attribute more than half of the returns to liquidity and narratives now. But there are some narratives that have, been espoused in the last 15 months or that have not played out. And yet these valuations have continued to get re-rated. So, the biggest narrative, of course, was that the government, the NDA government in India, will come back with a much larger mandate, right? All heard the slogans of Ab Ki Baar, 400 Par and all of that. And this mandate would therefore then come with significant path-breaking reforms, right? Because now they would not be beholden to anybody to, push forward a progressive agenda. However, come June 2024, the reality that played out was much, much different. The mandate was far weaker. The government far more fractured in the sense that there is larger dependence on the coalition partners this time around. And we're seeing that show up in the government's decision-making today. We're seeing, I won't call it lethargy, because it's not a lack of intent. It's not a desire to not push ahead a reform. It's more wanting to, or rather having to play the political game as well. So we've seen, that narrative sort of get the biggest blow. And I think a lot of the premium associated with India was that we had a very, very strong leader and a strong center that could push forward an agenda, without too many political concerns. And that sort of has been the biggest dent, I would say, to the whole narrative of India in the last quarter or so. And we believe that would lead to compression in multiples to a certain degree going forward. The other two things that people were really talking about is, this time around we'll see significant focus on rural spending. And this is something, of course, that we had alluded to ourselves as well, where we were expecting that this time around the government given the mandate they had come in with, will focus a lot more on rural spending in the budget. However, on the ground, none of that has sort of panned out in the last 3-4 months. We're not seeing too much activity on that side. We had in fact expected on private capex to start picking up, and government sort of putting their hands up and saying that this is as far as we can get you in terms of above trend spend on capital expenditure and defense expenditure. And there we've been sort of proven right, at least on the account of that the budget has sort of not seen a substantial increase allocated to these line items. But this was a narrative that was being spun in the market that, the defense and capital expenditure by the government will see a substantial increase in the budget. That did not happen. So a lot of narratives that were there in the last 15 months, a lot of stories that were being told about why the India story should be looked at and why this multiple, will sustain as long as we have such and such ruling authorities, etc. Those narratives are getting sort of deflated, and we believe that will result in some amount of valuation compression. However, having said all of that, we still maintain, like we have the last 2 times, that the valuation compression will come in terms of time correction, not in terms of a price correction. And when we say price correction, we mean a large price correction, right? A 10% move here and there in the markets is expected. It's par for the course in equity markets. When we say correction, we mean larger, steeper corrections, right? 15, 20%. And here we feel that the probability of these kind of corrections is low. Like we discussed, our current account deficit remains under 2% of GDP. Inflation is under control. Corporate earnings are there across sectors. Corporate asset quality is probably the strongest it has been. Government balance sheet is very strong. And, despite one would have to, give a tip of the hat to the government that despite coming in with a coalition mandate and having the temptation to sort of engage in all sorts of SOBs and welfare spending, which is par for the course in a large democracy like ours, they've kept their fiscal prudence at the forefront in the budget as well. So with all of that, we believe that we're likely to see a time correction rather than a price correction, because the 22% price growth and the 13% EBIT growth, there has to be some bridging over there. You cannot have such a big disparity between the underlying fundamentals and, where prices have gone up to. Of course, we're not expecting that, it will come down to only 13%, perhaps over a longer period of time, but not immediately so. But there will be some amount of time correction, which will eventually see the compression of the price CAGR and getting that number much, much closer to where the EBIT CAGR stands at today. So markets are not cheap. They're neither expensive. Simply because the earnings outlook stays for India. We are seeing compounding, a low double-digit compounding at the broader level in corporate profits in India. And as long as that sustains, as long as we're not leveraged, we believe that there is no reason, or there's no fundamental reason rather, for markets to correct dramatically. We don't believe that there are technical reasons. There are chinks in the armor in the narrative, yes, but there is nothing that can reverse liquidity overnight, right? Because the macros are so stable. We would, at this point of time, position ourselves more towards large cap. Again, this is something that we've been calling out for the last 2, quarterly discussions that we've had as well. But incrementally so. And I think we've seen enough data today where we've discussed how the multiple expansion in large caps has been far lower than, what we've seen in small and mid cap. So the big takeaway, if I had to give you all from today, at least what we believe the big takeaway should be, would be that broader market rallies, right? Where you bought anything and everything went up, right? That kind of a rally is now going to stop, or it has probably already stopped, right? We can only tell in hindsight whether, this is a temporary pause or the rally has stopped or whatever it is. So, all these narrative-driven things where you had a story being spun out on a particular company and without even any execution, you saw prices sort of going up in anticipation of what future would look like. Those kind of things that were happening in the markets where, you could pick up any new IPO issue and you would make a lot of money. Those kind of things are all going to come to a halt. I think there's going to be a lot more focus now on individual stock, individual company performance. This whole narratives being greater than earnings, we are going to see that reverse, and earnings will start becoming greater than narratives, I think. So if I had to take a clarion call for 5 years, last 5 years have been about narratives taking center stage and earnings sort of playing supporting role. I think the next 5 years would be earnings taking center stage and narratives playing supporting role, if any, right? So bottom-up stock picking will come to the fore. At this point of time, one thing that we can definitely advise every single investor looking to invest in India is please do not go down the quality curve to chase any more narratives. I think the time for that has passed us. So this is sort of our, take on the markets right now, that you will see a lot more consolidation, a lot narrower group in the market now seeing an appreciation in prices. This broad rally where we saw, 400 out of 500 stocks doing well. Now we're going to see the remainder 100 or some 100 stocks doing well instead of the 400. So at this point of time, any narrative-driven stocks, any thematic funds should be avoided. Focus on earnings and earnings alone. And I think that's where you will see the greatest resilience in returns going forward. If there was a macro concern that we had to highlight in India, this would be it, that for the last 5 quarters now, we've not really seen double-digit revenue growth come in for India. And that's saying something, right? We're the fastest growing important economy in the world. We're not being able to grow top line by more than 7-8% for the last 5 quarters. It's of course inching up a little bit, but there's only so much expansion in margins that we can see. I think this is going to be something that we'll have to continuously monitor, because at some point of time, your profit growth will come back in line with revenue growth. And we've seen that happen in the previous quarter, where we've seen a much slower increase come in. So we've seen a 8% growth in top line and a 3% growth in earnings. So, basically saying that, this is the extent to which the margins can take you now. So now really the earnings growth needs to come in from revenue growth. So again, just need to keep on focusing on companies that have an ability to continuously grow their revenues in double digits. And I think that itself will help you outperform the broader markets going forward. And this is a chart that we always show, that, how margins have shaped up. It basically tells us that we are anyways trending above average margins, and there's not much scope left for margins to improve from here on. So the last time around, we had a much longer discussion on, our sectoral ideas. So just recapping, we had discussed about how private banks would do far better than PSUs. In consumption, probably, the stock prices played out, but erroneously so, because we don't take any credit for that, simply because we've not seen our fundamental thesis play out. We were hoping for a near-term K-shaped recovery in the economy flattening out. What that essentially meant is we hoped that the bottom of the pyramid would start consuming a lot more than what they were. And the reason why I say our fundamental call hasn't played out is more because the government spend on rural that we were expecting has not really come through so far. So while two-wheelers have done really well, I think they've done well because their base was much weaker last year. I don't think they've done well because there's just been a genuine uptick in consumer sentiment in India right now. I think while the stocks have done well, two-wheelers, FMCG, especially in the last quarter, they've done exceedingly well compared to the rest of the market. We think that this is more, again, similar to the move that we've seen in gold, where people are wanting to shift to safety. There is a move to safety here, and people are wanting to shift to staples rather than, they want to be invested in the Indian equity markets, but not really take a bold call on the exuberant sectors right now. So it's not a call on, the government really having changed their course in rural spending or something like that. It's more either the base was weak, as was the case with two-wheelers, or simply that there's been a shift to safety that has happened. The other call that we had last year was private capex, needs to pick up, and then government's heavy lifting on capex is done. I think the second part has come out right, where the government's heavy lifting on capex is done, but I think we are yet to see private capex pick up. And I think that is something that we will definitely see post monsoons. I think monsoons in India are generally a lean period for capital expenditure. And the moment monsoons get over, so right about now, we will see a step up happening in private capex. So that's something that we still hold as a view. And pharma is something that we've discussed at length. So, we're not getting into that again. But what are we saying now? So where, apart from all that we've discussed so far, where are the incremental opportunities? I think our strongest call remains private banking. I think we've discussed how valuations and financials remain favorable. Why private banking? Because we believe that the whole reversion to mean trade that was happening in PSUs, that is over, right? We've seen PSUs now in some cases trade at multiples at which private banks are trading at. And at the end of the day, there is always going to be a risk that the government will use the PSU bank's balance sheet to further their own agendas. So that's not something that we are comfortable investing in for the longer term. I think there are select few private banks in India today that are seeing 15% growth at 15% plus return on equity, and they're trading at 2 times price to book on a 1 year forward basis. So I think if this is available, I think this is a great place to position oneself in. And I think this is the only sector we've seen where multiples are now below their pre-COVID levels. So all in all, we believe that private banking remains to be a top priority to allocate money to. The other two segments we wanted to discuss today, one was power. I think energy transition is something that we are seeing across the world. In fact, if you were to flip through any business channel in the US, the most discussed topic from a industry perspective, not of course from probably the most discussed topic would be oil prices or the geopolitical situation, but from a business perspective, the most discussed topic would be the fact that there have been a record number of power outages in the US, right? And this is a phenomena that we're seeing happen across the world, where just the amount of electricity that the Western world, the developed world rather, is consuming, which had stagnated for a long period of time. We're now seeing an increase over there. Even in India, there has been a constant increase, power consumption, and incrementally more and more of the world is shifting either to renewables or probably in the longer term to nuclear. So there is a lot of investment that needs to happen, which goes beyond investing in these assets, right? So there's of course the solar power plant or a park rather that you would put up, but to evacuate power from these new locations, wherever you're putting up a solar plant or a wind farm, you do require a lot of support on the transmission and power distribution front. There's going to be a lot more investment that happens as a result on that front. So we prefer these capex ancillaries, right, where there would be something in the T&D space where there would be some ancillary required. You may require a transformer in the middle. You may require to change the voltage so that you can alter the flow of the current, things like that. You may require some other meters and gauges and stuff like that. So we will prefer to look at these capex ancillaries over OEMs, so over the power producers themselves. But we think that this is a long-term theme, and while everybody's focusing on solar per se in India today, everybody's focusing on making the panels, setting up the panels. The panels can't deliver you power unless they're connected to a grid, and I think that part is something that we would choose to focus on a lot more. The other thing is, post-COVID, we've seen such a resurgence in real estate in India. Since 2014, we've seen real estate be fairly tepid in India. And then post-COVID, we've seen traction in volumes pick up. And all of these pre-sales and sales that have been done in 21, 22, they're now going to come, and fructify into actual deliveries. And when they fructify into actual deliveries, there's going to be a lot of spending that we envisage on building products, right? So on sanitary ware, on your tiles, on your paints, various appliances in the household. So we believe that this space of building products is something that can see both top line growth sustaining and margin expansion, because these companies as a basket currently are operating at the lower end of their margins. So valuations are fair over here. We're not making a case for supernormal returns, but there is a lot of scope for fundamentals being very, very strong over here. So like I said, earnings center stage, and perhaps no supporting role to be played by narratives or liquidity. These would be the three segments that we would look at to invest in Indian equities. And that's it from our end. We hope you have a very, very happy festive season. Maybe my conversation today or my narrative today might have seemed a not so happy narrative, but I think, our expectations need to be tempered in terms of what we expect from Indian equities and equities in general. Expectations of having returns consistently be over 20% at an index level is just not going to happen, because even in the last 5 years of, extreme bull run, we've seen an operating profit growth of 13%. So with that in mind, it becomes very difficult for us to really think that, next 5 years. So last 5 years when the government had the strongest mandate, you've seen a 13% growth in EBIT. Why should the next 5 years see anything greater than 13-14% growth in EBIT, right? So if that is the case, my price CAGR from 22% has to come closer down to 13-14%. So I think just bear that in mind. There will always be opportunity in the markets. We're not expecting price correction, so it's not we're not sounding any alarm bells. We're just simply saying that, one needs to really moderate expectations going forward. That's all from us. Thank you so much, Dr. Bhatt, for having us, and look forward to discussing the next quarter with you again. Thank you so much.
Dear viewers, hope the video that I have done today with fund manager Harini Dedhia gave you the insights about what is happening in the Indian stock market as well as the international stock market, and help you to take a measured, informed decision when you invest your hard-earned money in the Indian stock market. If it did help you to guide you through the right decision making, please do give me a thumbs up. If you are somebody who is yet to subscribe for this channel, please do hit the subscribe button and press the bell icon. Do not forget to share these videos with your near and dear ones, friends and relatives, and on all the social media handles on which you are connected with. Thank you very much for watching this episode on NRI Money Clinic. I will be back with you with yet another episode of Expert Speaks next Tuesday. Till then, stay safe. Jai Hind.
Press the bell icon for more details and subscribe our channel.